What if I told you the biggest financial heist in modern history didn't happen in a dark alley or offshore account, but in broad daylight right in front of every American's eyes? What if the 2008 collapse wasn't an accident, but an engineered event, a coordinated maneuver to consolidate power, erase accountability, and lock the global economy under one unbreakable system of debt? Because in September 2008, $800 billion vanished overnight, gone, erased, shifted from public balance sheets to private shadow networks. And the official explanation? Liquidity management. That's the sanitized phrase they used while families lost homes, jobs, and entire retirements. But dig deeper and you find something far more sinister. A hidden financial pipeline the Federal Reserve used to quietly funnel money to select global institutions, bypassing Congress, oversight, and the American people. A shadow system that didn't just save the economy, it transferred ownership of it. This isn't about old news. This is the foundation of today's inflation, your shrinking savings, and the illusion of economic recovery. Every crisis since COVID bailouts, banking collapses, crypto regulation has used the same playbook that was written in 2008. Where are you watching from? Drop it in the comments, because this community is global, awake, and done being lied to. And if you're ready to see the unfiltered truth about the system that controls your money, hit subscribe. Because tonight, we're unsealing the biggest financial cover-up of the 21st century. To understand the $800 billion that vanished, we need to rewind to the calm before the storm. It's 2006. Wall Street's in a frenzy. Mortgage-backed securities, bundles of home loans repackaged into investment gold, are flying off trading floors. Everyone's getting rich. The media calls it innovation. Sound familiar? The banks Lehman Brothers, Bear Stearns, Goldman Sachs had discovered alchemy. They could take toxic subprime mortgages, bundle them, rate them AA, and sell them worldwide. And the buyers? Pension funds, insurance companies, even foreign central banks. Everyone wanted a piece. The profits looked endless until the first cracks appeared. By mid-2007, default rates doubled. But instead of stopping, the banks doubled down because they knew something you didn't. They weren't just betting on the housing market. They were betting on the collapse of the housing market. Credit default swaps insurance on failure became Wall Street's new lottery ticket. The worse the loans performed, the more money insiders made. And as the system began to rot, the Fed sat silent. In August 2007, the first tremors hit. France's BNP Paribas froze withdrawals from mortgage-linked funds. In America, liquidity dried up overnight. By March 2008, Bear Stearns collapsed. Then, 6 months later, Lehman Brothers. You remember the panic. Stocks plunging, news anchors shaking, politicians warning of total economic meltdown. They said the government had no choice but to act. Sound familiar? In a single weekend, the Fed and Treasury declared a new age of emergency measures. Congress authorized $700 billion for the Troubled Asset Relief Program, TARP. But here, that's the first red flag. $800 billion, not $700, actually disappeared from official ledgers. An unexplained expansion. No oversight, no receipts, no transparency. So where did it go? The official story. Liquidity operations. The truth. A secret web of cross-border dollar swaps, hidden facilities, and backdoor bailouts to foreign banks and hedge funds. Sound familiar? It should, because that's exactly what happened again in 2020, and it's happening right now. The 2008 bailout wasn't a rescue. It was a reset. A shift from a free market to a managed one. And while the media screamed about greedy homeowners, the real culprits were writing history in the shadows. You see, the collapse wasn't chaos. It was choreography. Every step planned, measured, executed. Because to consolidate global control, first, you must collapse the illusion of control. And who benefited? The same institutions that caused the collapse. Goldman Sachs, Citigroup, JP Morgan, BlackRock. Each was given billions in emergency funds through opaque Fed programs, while the public narrative focused on saving Main Street. The irony? The liquidity the Fed claimed was missing was never missing at all. It was redirected from public systems into private, offshore, and shadow accounts that would later form the foundation of today's shadow banking empire, estimated at over $52 trillion. Now here's where the story takes its most chilling turn. The Fed didn't just hide where the money went. It created a brand new mechanism to make it disappear without ever calling it printing money. It was called the Central Bank Liquidity Swap Line, a term so dull it sounds harmless. But in reality, it was the single most powerful financial weapon ever deployed in peacetime. Here's how it worked. Instead of handing out dollars to US banks, the Fed lent trillions in secret to foreign central banks, who in turn passed that liquidity to private banks and hedge funds overseas. In total, the GIO later uncovered $16 trillion in emergency loans issued through these hidden channels. But the public was told it was $700 billion. Why the deception? Because if Americans knew that while they were losing their homes, the Fed was bailing out European megabanks, Asian conglomerates, and Wall Street insiders, there would have been riots in the streets. The swaps weren't temporary. They became permanent fixtures of the global financial architecture, quietly renewed, extended, and expanded every time markets trembled. A silent pipeline connecting the Federal Reserve to every major banking hub on Earth. And that $800 billion that vanished. It was the seed capital, the first covert transfer into this hidden global lifeline. The moment when America's money stopped serving its people and started serving the network. But who built it? Who authorized it? And who profits every time the system nears collapse? You won't believe the name, because it wasn't just a banker or a politician. It was someone whose fingerprints appear in every crisis since 2008, every market panic, every stimulus, every so-called rescue. And when you see the receipts, the receipt is wilder than you think. The name that keeps reappearing in every document. Let's break it down. The crisis begins. Lehman falls. The markets freeze. The Fed's balance sheet explodes from $870 billion in early 2008 to $2.2 trillion by the end of the year. That's a 150% increase in just 12 months. But the true shocker came not from the amount, but the recipients. According to the Government Accountability Office's 2011 audit, the Fed secretly issued $16.1 trillion in cumulative loans to institutions worldwide. Recipients included Barclays plc, $868 billion, Deutsche Bank, $354 billion, and UBS, $287 billion, all foreign banks. Even Toyota, GE, and McDonald's tapped the facilities for cheap liquidity. Meanwhile, millions of Americans were losing their homes. Why would the U.S. central bank funnel money overseas while domestic banks were collapsing? Because these foreign institutions were counterparties to the same derivative contracts that linked Wall Street to the global system. If they fell, the entire network fell, and with it, the dollar's supremacy. So, the Fed quietly chose preservation of empire over protection of citizens. The weapon of mass deception was the derivatives market, a labyrinth of bets so large it dwarfed the real economy. By 2008, the notional value of outstanding derivatives had surpassed $680 trillion. That's roughly 10 times global GDP. These contracts weren't traded on exchanges. They existed in the shadows. And who stood at the center of that web? AIG. When AIG's bets on mortgage securities imploded, the government said it had to be rescued. The official bailout cost? $182 billion. But internal Fed data later revealed the actual exposure, nearly $1 trillion in derivative guarantees to Goldman Sachs, Societe Generale, and Deutsche Bank. AIG wasn't bailed out to save jobs or insurance customers. It was bailed out to pay off Wall Street's side bets. Bets that would have triggered a global margin call. That's the real meaning of systemic risk. Not the failure of one company, but the exposure of an entire architecture of synthetic money that never truly existed. So, when $800 billion vanished, it didn't disappear, it evaporated into balance sheet illusions, closing holes that never should have existed. Once the swap lines stabilized the network, the Fed rolled out its next trick, quantitative easing, QE. They told us it was to stimulate growth. In truth, it was to permanently inflate asset values and keep the newly bailed out institutions solvent. QE1 in 2008, $600 billion in mortgage-backed securities. QE2 in 2010, $600 billion more in treasuries. QE3 in 2012, $85 billion per month, open-ended. By 2014, the Fed's balance sheet reached $4.5 trillion. Yet median household wealth in America fell by 39% between 2007 and 2010. Top 1%, meanwhile, gained 27%. QE was never about recovery. It was about recapitalizing the elite. Here's the quiet horror. Every dollar created by QE entered the system as debt. It wasn't printed money. It was borrowed money owed back with interest to the same institutions that received it. That's why inflation today isn't a mystery. It's the delayed aftershock of a rescue that was never paid for. While QE and swap lines captured headlines, a new financial monster grew beneath the surface, the shadow banking system. By 2015, it was worth $75 trillion. Today, it exceeds $100 trillion. This system isn't regulated like traditional banks. No deposits, no FDIC insurance, no transparency. It exists through repos, money market funds, and structured investment vehicles, private markets where the real cost of money is set. And who owns it? The same names that received the Fed's 2008 bailouts: BlackRock, Vanguard, State Street, Citadel. They became the de facto shadow governors of the global economy. In 2020, when markets froze again due to COVID, the Fed didn't call Congress. It called BlackRock to manage its bond buying programs. The same company that profited from 2008 was handed the keys to the entire U.S. credit market. That isn't a rescue. That is capture. There are 5 numbers they don't want you to remember. $16 trillion. Total secret Fed loans 2007 to 2010. $800 billion. The unaccounted gap between TARP authorization and real Fed flows. $680 trillion global derivative exposure in 2008. 39% drop in U.S. median wealth after the crisis. $100 trillion size of today's shadow banking system built on those foundations. Each figure is a monument to how the crisis was never resolved, only relabeled. Here's the truth that ties it all together. The 2008 collapse wasn't a failure of capitalism. It was the completion of a takeover. By collapsing credit markets they controlled, the Federal Reserve and its private partners gained legal justification to monetize debt on a scale never seen before. The liquidity swaps and derivative rescues weren't temporary. They were the birth of a permanent global money network operating beyond borders and laws. And that network is still running today. Every time a crisis hits 2020, 2023 bank runs, even crypto volatility, the same lifeline is reactivated. Liquidity flows from the Fed to foreign central banks to private actors, while the public is fed the illusion of stability. The permanent consequence? The United States no longer controls its own monetary destiny. The dollar became a weapon of the network, not the nation. And the $800 billion that vanished overnight? It was the price of entry into a new financial order that none of us voted for. We were told the 2008 crisis was the worst since the Great Depression. But what if it was actually the beginning of something far bigger, a a silent transition to a system that can never be unwound. Because today, the same tools that engineered the bailouts are wired directly into digital currencies and AI-driven financial platforms. CBDCs, instant settlements, algorithmic credit scores, each one a child of that original 2008 architecture. The next collapse won't take months. It'll take minutes. And the response will be automatic pre-programmed liquidity flows that bypass nations entirely. That's what efficiency really means in today's financial language. Ask yourself, when money moves faster than democracy, who really owns it? When every crisis transfers wealth upward, is it still a market? Because after every rescue comes a redesign. 2008 built the blueprint. 2020 tested the software. And 2023 proved the code still runs. When the world locked down, the Federal Reserve once again opened its invisible spigot, this time injecting over $9 trillion into markets within months. The public heard the word stimulus. The insiders called it continuity of liquidity. Sound familiar? Except this time, the bailout wasn't just for banks. It was for systems, corporate bonds, tech monopolies, algorithmic trading networks, even passive ETFs managed by the same firms that engineered 2008 replaced on artificial life support. Behind closed doors, the Fed's primary dealer credit facility and commercial paper funding facility quietly funneled trillions through the same shadow banking corridors created back then. Only now, the conduits weren't spreadsheets, they were servers. Automated, optimized, and invisible to the public ledger. And here's the twist. Those swap lines you heard about earlier, they never closed. They multiplied. By 2022, 14 foreign central banks were permanently wired into the Fed's balance sheet through standing arrangements, essentially turning the dollar into a global operating system rather than a national currency. While the headlines screamed inflation and supply chain crisis, a new financial architecture was taking shape underneath. Central bank digital currencies, CBDCs, were quietly being tested in over 130 countries, all using a nearly identical framework first modeled by the Federal Reserve Bank of Boston in partnership with MIT. Officially, CBDCs promise efficiency and inclusion. Unofficially, they offer programmability. Money that can expire, be geofenced, or limited to approved purchases. In other words, the perfect enforcement layer for a system born from emergency liquidity. And who's advising the IMF, the BIS, and dozens of national central banks on digital currency integration? BlackRock. Same name, same fingerprints, same revolving doors. This isn't decentralization, it's recoding centralization in digital form. The $800 billion that disappeared wasn't a one-time loss. It was the down payment on this programmable future. Now, add one more layer. Artificial intelligence has entered the trading floor. Today, over 70% of all market orders are executed by machines that react in microseconds to liquidity signals. Signals generated by the very central banks claiming to stabilize volatility. AI doesn't just follow policy, it anticipates it. It trades on whispers before humans can blink. What happens when policy itself becomes algorithmic? When liquidity injections are triggered automatically by predictive models? When the same networks that created moral hazard now self-replicate without oversight? That's not a safety net. That's a self-learning monopoly on money. And while we debate recessions, inflation, or elections, the deeper shift has already occurred. Nations no longer decide their own monetary fate. Their central banks synchronize interest rate moves within hours of each other, all calibrated to the same benchmark, the US dollar's shadow price of liquidity. It's not a conspiracy theory. It's an API call. A unified global algorithm running quietly in the background of every financial terminal. In 2008, the question was who bailed out whom. In 2025, the question is who programs the bailout. Because the next crash won't look like 2008, it'll look like a software update. One command, executed globally, repricing assets and rewriting digital ledgers in seconds. No hearings, no votes, no visibility. When confidence finally breaks again, and it will, there won't be helicopters dropping cash. There'll be notifications. A push alert on your phone that says, "Emergency liquidity access approved." Your digital wallet refills. Your freedom shrinks. And that's when the circle completes. The same structure that started as a secret liquidity swap in 2008 will have evolved into a total liquidity system, global, programmable, and irreversible. The elites won't need to hide bailouts anymore. They'll simply automate them. So, when you hear politicians debate debt ceilings or budget cuts, remember those are stage props. The real ceiling was removed long ago, replaced by code that creates money faster than trust can keep up. 2008 wasn't the end of an era. It was the upload of one. The next financial crisis won't ask for permission. It'll just execute. And when it does, remember this story. Remember the $800 billion that vanished overnight, and the system that grew in its shadow. Because the cover-up never stopped. It just upgraded its software. Don't stop here. There's always another layer, another secret behind the curtain. Watch the next video on your screen and keep digging. The truth doesn't reveal itself. It rewards those who search.